Hello. The last video for Chapter 8, focuses on, we'll start on page 830. This will not be a very long video because a lot of this stuff you will probably not run into very often, but if you do, it can be kind of sticky. All right. On page 830, they talk about something called Section 1031, like-kind exchanges. Okay, this is also commonly known as a starter exchange. All right, when you have property, okay, a lot of times, somebody may come along and say, I've got a piece of property and would you like to swap? All right, kind of like playing Monopoly, but doesn't always involve cash. And I've had several clients who, for example, have had, like 2 or 3 houses up here in South Bend, Mishawaka, and they get a chance to maybe get a Florida condo or an Arizona condo or something like that. All right, so you kind of look at the fair market values of all the properties, and you say, hey, do you want to make a like-kind exchange? All right, and it's great because it allows people to acquire different properties with little or no cash outlay. You're basically just swapping real property for real property. Okay, now, and that is the important thing on a like-kind exchange. That's why it's called a like-kind exchange. So you cannot exchange, for example, a $100,000 house for a $100,000 car. All right, a house is real property, a car is personal property, so they are not like-kind. Okay, but you could depreciate, for example, a 4-unit apartment building for a single-family condominium. All right, that counts because that's both real property. All right, you could exchange, office furniture for office furniture, but you can't exchange office furniture for a computer because they're not the same thing. All right, so what you are going to see most often is real estate. Okay, so let's take a look at page 830. All righty. I have done several 1031 exchanges over the years. They are not the easiest thing to do. All right, you've got to make sure you get it right, because the problem is that unlike a sale where you know what the purchase price was, when the selling price was, and you can figure the gain or the loss fairly easily, on a like-kind exchange, okay, there is no tax effect in the current year. Alrighty, any potential taxable gains are deferred until the asset is finally sold, okay, instead of exchanged. So you have to make sure that you get the basis right and transferred from the old property, okay, to the new property. So how do you know what the basis is? Well, it tells you on page 830. Okay, so what you do is you, first of all, you ask yourself, did you pay any boot? All right, boot is basically cash. Okay, did you pay any cash? If you do, that increases your basis. Did you receive any boot? Okay, or did you receive any cash or some other kind of an asset? If you did, that reduces your basis. Okay, and then any gain that is recognized is added to the basis of the property received. Okay, all right, so let's take a look at the example that is on page 831. Okay, it says Janice and Kevin exchange real estate held as an investment. All right, Janice gives up property with an adjusted basis of $350,000 and a fair market value of $560,000. The property is subject to a mortgage of $105,000, which is assumed by Kevin. In return for this property, Janice receives from Kevin property with a fair market value of $420,000 and cash of $35,000. All right. Kevin's adjusted basis on the property that he exchanges is $280,000. Okay. So let's take a look at the first thing that they show. It says Janice recognizes a gain of $140,000 equal to the lesser of the gain realized or the boot received. All right, and you can see the two calculations that were made. All right, okay. So the first calculation was the fair market value of the property he receives. All right, 420. That's what he got from Kevin. All right, or she got from Kevin. All right, okay. All right. Janice also receives $35,000 in cash. Plus, Kevin assumes Janice's liability on the property of $105,000. Again, it is as if Kevin had, given Janice $105,000. Janice would have paid off the mortgage. Okay, all right. So any liabilities that are assumed by the other party, okay, all right, increases your gain. All right, so the total amount that Janice realized was $560,000 less the property given up. Janice had a gain of $210,000. All right, now look at the boot. All right, Janice received $35,000. Liability that was assumed by Kevin was $105,000, so the total boot received was $140,000. The gain that is recognized is the lesser of the $210,000, all right, or the $140,000. All right. Okay. So what happens here, all right, is you have to calculate the basis of Janice's property. All right. So this becomes pretty important. All right. So go take a look at number 2. All right. Okay. Janice gave up, all right, a property worth $350,000. They didn't pay anything. All right. The boot received was $140,000. The gain recognized was $140,000. So the basis of the property that Janice has received is $350,000. Okay. Then you have to calculate Kevin's basis. All right, in the properties that were exchanged. All right. In Kevin's case, the basis of the property that was exchanged was $420,000. Okay, generally the rule is on like-kind exchanges, alrighty, is that since there is a built-in gain that is being deferred, alright, the property you are acquiring has to be valuable enough in order to absorb that property. So if you are getting rid of a property that where you have a gain of, let's say, $50,000, you have to make sure that the property you acquire has at least a value of $50,000 in order to absorb that gain. All right. Otherwise you would have a loss and there would be no Section 1031 transfer. Okay. This discussion of 1031 gets to be extremely complicated. All right. Probably is maybe better left for advanced textbooks, but again, the software will help you out a little bit if you do a 1031 exchange. The one thing also that you have to remember, that if you get a client who says that they want to start exchanging properties, you need to tell your client that they have to use a qualified intermediary. All right, a qualified intermediary is usually a title company. So basically how it works is that the title company will acquire the titles to both properties. Okay, then they will do what they need to do. They'll get the settlement contracts ready and all that stuff. Okay, and then they will transfer the titles back to the new owners. All right. But here's the key. You have to use a qualified intermediary to do this. If you do not, then any gains are immediately taxable and reported on your tax return for that year, and there is no Section 1031 exchange. It's not an exchange anymore, it's a sale. Okay, so, all right, so basically the two rules of Section 1031 are this. Number one, you have to acquire a property that is of equal or greater value than the one you're giving up. And number two, you need to use a qualified intermediary to make sure that any built-in gains on the property you're giving up gets transferred into the new property, and then you'll pay taxes when you sell that property eventually, if ever. All right. Okay, and then the very last item I want to talk about in Chapter 8 is something called the involuntary conversion. Basically, I talked about that earlier. That would be, for example, let's just say, for example, your house burns down or your car gets wrecked and you get an insurance settlement. All right. Any losses, all right, I've already mentioned, are not deductible on a tax return. If you have a gain, however, those gains may have to be included in income unless the proceeds from the insurance settlement are reinvested in the same type of property. In other words, if your house burns down, you build another house. If your car gets wrecked or your car gets stolen, and they give you a check, and you have to make sure that you reinvest it in another car. All right. Otherwise, if you just take the cash and you don't reinvest it in the same like-kind property, all right, any amount that you receive from the insurance company in excess of the adjusted basis of your car or house, or in the case of a car, what it would be called the Blue Book value. Any excess there would be treated as ordinary income, all right, and you'd have to report that on your tax return. Okay, the last subject on page 833 and 834, I generally don't talk about too much because it involves the sale of a personal residence. All right, since 1997, okay, you only have to include the sale of a personal residence on your tax return if the amount of the gain is greater than or equal to $500,000 if you are married filing a joint return, or $250,000 for other filing statuses. All right, and usually in this area, you're not going to have that size of a gain. Now remember, it's the amount of gain, not the selling price. All right, so if you buy a house for $50,000 and you put $20,000 into it for a total of $70,000, all right, you would have to sell that house for $570,000 if you're married filing joint, or $320,000 if you're any other filing status, before you even have to worry about reporting the gain on the sale of a personal residence on your return. Okay, that ends this last video for Chapter 8.